$330 billion. That's how much cash Warren Buffett is holding today. It sounds massive, more than the GDP of Finland, but that number alone doesn't tell us much. What matters isn't the absolute figure, it's the proportion. Today, cash makes up almost 30% of Berkshire Hathaway's total assets. That's where the real signal is. Because every time Berkshire reached this kind of level, a downturn wasn't far behind. In 2000, in 2008, and in early 2020. But it's not that simple. In 2008, Buffett started piling up cash years in advance, back in 2004 and 2005. And he was still buying just before the crash. So, is this another warning sign, or something else entirely? One thing's for sure. This time, there's more to understand. And the implications run deeper than most realize. Look at this chart. This is Berkshire Hathaway's cash pile, quarter by quarter, from 1996 to 2024. In the early 2000s, a steady climb, right before the dot-com bust. Then again, in 2004 and 2005, cash builds up ahead of the financial crisis. After 2016, another wave of accumulation. And in early 2020, right before COVID. He doesn't always buy at the top or bottom, but his cash tells you how he feels. And now, an explosion. $330 billion in cash. More than ever before. More than the GDP of Finland. Let's talk about how he uses it and why he's not using it now. Buffett never saw cash as deadweight. He called it a strategic reserve, ready to move when others are paralyzed. In 2008, when fear gripped the system, he deployed billions into Goldman Sachs and Bank of America, not at the bottom, but right in the chaos. As he famously said, only when the tide goes out do you discover who's been swimming naked. And Buffett bought from those swimmers, stripped by margin calls, panic, and forced selling. That's the power of liquidity. It lets you buy when quality assets are on sale at historic and ridiculous discounts, while most players are just trying to survive. 2020 was different. Instead of hunting, Buffett retreated. He sold the airlines at the worst moment. He avoided large-scale acquisitions. He did buy back Berkshire stock and entered selective positions, Chevron, Verizon, Snowflake. But the bold moves never came. Today, with even more cash on hand, he still hasn't struck. Which raises the question, is he waiting for the tide to recede again? Or has the tide already turned? One piece is still missing. The most recent 13F shows no major move, no big acquisitions, no bold bets, but it only covers Berkshire's portfolio until March 31st. The market sell-off accelerated in April. If Buffett acted, we won't see it until the next filing in August. Until then, we're watching a giant sitting on $330 billion in cash, in total silence. If you want the full data, including every chart we showed, plus the detailed timeline of Buffett's positioning, download the Warren Buffett Positioning Report in PDF format. The link is in the description. Glacium research tracks the structural forces driving markets through cycles, asset classes, and volatility. Over the past 4 decades, Berkshire Hathaway has delivered one of the most consistent and powerful investment performances in modern history. Since 1981, the company has compounded at 19.8% per year. The S&P 500, just 11.4%. That difference may sound small on paper, but it's the reason Buffett became one of the richest men on earth. Compounding at that scale changes everything. In the early years, Buffett had agility. He could buy undervalued small businesses and scale them into cash machines. But as Berkshire grew into a $900 billion behemoth, opportunities shrank. It's hard to make bold moves when your trades move the entire market. Still, Buffett kept outperforming, not by taking more risk, but by compounding retained earnings and staying disciplined. Unlike traditional funds, Berkshire doesn't manage outside capital. It doesn't have to chase returns or stay invested when markets are overheated. It plays by different rules. Most fund managers receive cash from investors and are forced to deploy it, even when prices are sky high. Berkshire doesn't. It can sit in cash for years and wait. And while it waits, it keeps accumulating more. Because Berkshire doesn't just hold stocks. It owns cash-generating businesses, railroads, utilities, and, above all, insurance. These businesses produce steady cash, regardless of what markets do. And that cash becomes fuel to buy when others can't. But even uninvested, that cash isn't idle. Berkshire holds over $100 billion in short-term U.S. treasuries, earning more than 5%, with virtually no risk. Today, it controls nearly 5% of the entire T-bill market. So even when it does nothing, it earns, quietly, efficiently, relentlessly, and the result speaks for itself. Since 1990, Berkshire has delivered over 9,000% in total returns. The S&P 500, just 1,450%. Since 2010, 800% for Berkshire versus 530% for the index. And even post-COVID, between 2020 and 2025, 132% for Berkshire compared to 65% for the S&P 500. That's not luck. That's structural discipline through every cycle. Berkshire Hathaway wasn't always a giant. It started as a failing textile business, slow, outdated, and on the verge of collapse. In 1965, Warren Buffett took control. But instead of shutting it down, he used the company's cash to start buying insurance firms. Why insurance? Because it came with something Buffett understood deeply: float, capital you receive upfront but don't have to pay out for years, a pool of investable money that compounds in the meantime. Over the decades, he used that float to buy businesses like See's Candies, Geico, BNSF Railway, and later, Apple, Coca-Cola, American Express. Today, Berkshire Hathaway is one of the most valuable companies on earth. A holding company, yes, but also a fortress, built on float, on discipline, and on time. Berkshire Hathaway isn't a fund, it's a cash machine. At the top, two engines, operating businesses and insurance float. These units generate cash every single day, steady, predictable, scalable, and they all report to one structure, Berkshire. That cash is then reallocated, not quarterly, not under pressure, but strategically, into two destinations: cash reserves and a concentrated equity portfolio. It's not just investing, it's capital recycling. Buffett doesn't wait for liquidity, he creates it and compounds it again and again over decades. Berkshire Hathaway is known for its long-term strength, but contrary to what many believe, it doesn't always outperform during recessions. In 2001, during the dot-com crash, Berkshire dropped just like the market. In 2008, same story. It fell hard alongside the S&P 500. And in 2020, during the COVID panic, Buffett even underperformed, selling airlines at the worst possible moment. But here's the difference. Where others took years to recover, Berkshire came back stronger, faster, and with more firepower, because that's where the real advantage lies, not in avoiding the storm, but in having cash, clarity, and conviction after it hits. Berkshire doesn't shine in chaos, it shines in recovery. Historically, betting on Berkshire when a recession was coming hasn't worked. It doesn't hedge the downturn, it falls with the market, sometimes harder. But once the panic fades, once volatility drops, and a new cycle begins, that's where Berkshire shines. In low VIX, long-term bull markets, the compounding kicks in, and the outperformance returns. In those environments, betting on Berkshire has always been a great move. Berkshire's portfolio isn't a tech-heavy momentum bet, it's a concentration of conviction. At the top, Apple, nearly 50% of the equity portfolio. Then Bank of America, American Express, Coca-Cola, and Chevron. These are not trades, they're long-term economic franchises. But something changed in 2024. Buffett cut Apple by 62%, yet it still dominates the portfolio. He reduced Bank of America, sold out of Citigroup, and trimmed Capital One and new holdings. In total, Berkshire sold more than $4.7 billion in stocks during Q1 2025 and bought only $3.2 billion. For a market in distress, that's remarkably cautious. But here's the key detail. This 13F only shows positions as of March 31st. It doesn't include the violent correction that followed, triggered by Trump's new tariffs and the market's reaction in April and May. So if Buffett acted during the crash, we won't know until August when the next 13F is released. And yet, there's a mystery. A confidential position has been hidden from the public 13F, estimated between $1 and $2 billion. Buffett may still be buying. We just don't know what or where. For now, the portfolio remains quiet, stable, defensive, and heavy on cash. It seems increasingly clear. Warren Buffett has entered the final chapter of his legendary career, and Berkshire Hathaway is changing. In recent years, he hasn't executed a major home run acquisition. Not since 2008, when he injected billions into U.S. banks during the heart of the financial crisis. Since then, he's gradually stepped back. The deals have become smaller, less bold, often led by his deputies. Short-term moves, like the buy and sell cycle in TSMC, stand in contrast to Buffett's old playbook, multi-decade conviction. During the COVID crash, Buffett exited the airlines at the worst possible time. For a man who thrived in crisis, this marked a clear shift. More caution, less action. Today, Berkshire holds over $330 billion in cash. But this cash means something different now. It's not just about waiting, it's about succession. Buffett no longer makes the calls. He consults, but the capital is deployed by others, and the environment has changed. Berkshire sees no massive opportunity that meets its standards. Valuations remain high. And the tech sector, they simply don't touch it. Not because it's overpriced, but because it's not their game, and the firm refuses to compromise on its principles. Meanwhile, Treasury bills yield over 5%, with no risk, no urgency. This is a situation Berkshire has never faced before, a mix of elevated markets, a changing of the guard, and a world where waiting pays. Berkshire is sitting on an empire of cash, at the top of the cycle, with the next chapter still unwritten. Following the passing of Charlie Munger, his lifelong partner in investment and wisdom, and Warren Buffett's decision to step down as CEO in 2025, we pay tribute to a legacy that reshaped modern investing. They didn't just build a company, they built a machine designed to last, and even without Warren, Berkshire will endure.